Thank you and welcome into this video. I would like to walk you through the controversial and highly contested Finance Bill 2026-2027, though it focused on the compliance area rather than the revenue generating side or the revenue generating measures. There were some controversial tax raising measures which were suggested by the National Treasury, but the Parliament voided them or dropped them. Some of them were dropped in the committee stage and they didn't get the chance to get to the floor of the House. But here are some of the controversial clauses which were dropped by the Parliament. But they didn't do this willingly. It was due to the public pressure and a lot of pressure from social group. So these are some of the controversial clauses which Parliament dropped. One of the clauses that was dropped by the Parliament was the 5% withholding tax on the custom value of the Mutumba cloth. The National Treasury was suggesting to introduce 5% withholding tax on the custom value of the Mutumba cloth. As we know, when importers import Mutumba cloth into the country, they usually a pre-existing 16% VAT on that Mutumba cloth from plus other taxes. But in additional to that, the National Treasury was proposing a 5% withholding tax on the custom value of the Mutumba cloth, which was a pre-assumptive tax, which was assuming that the profit margin which the Mutumba importers usually make after selling their bales into the market, it is 5% of the custom value, which is the amount which they were suggesting to be the amount of the withholding tax, which was pre-assumptive since these Mutumba importer have already imported their cloth, and in additional to their cloth, they pay their tax in advance. That's why they are calling it a withholding tax, which I context and I in my view, I think it is supposed to be called a pre-assumptive withholding tax, since withholding tax is usually deducted when the money have been earned, but this one is being deducted before the money has been earned by the importers of Mutumba. Since this what it translated to, it was increasing the cost of Mutumba at the point of contact at the port, which the Mutumba wholesalers will end up and shift this cost burden to the wholesalers, and the wholesalers were to pass the cost burden to the retailers, who could end up and pass the cost burden to the consumer of the Mutumba. And that meant a hike in the cost of Mutumba clothes, which could make it unaffordable, and it could now start competing with the domestically manufactured clothes, which are in most cases costly in most scenarios, since rarely you get a lot of Kenyan wearing clothes which have been manufactured domestically. But protecting this market, I don't think it really makes a lot of sense. We should allow them to compete with Mutumba in a fair play in the market, and they will get into an equilibrium when there will be a competitive advantage of producing this clothes domestically. Also, there was a second tax which was also controversial and ended up to be dropped by the Parliament, and that tax was the tax on importation of smartphone, which they could. There was a tax which was suggested, an excise duty of 25% at the point of activation. What this meant, the government was trying to harmonize all the tax which involve the importation of the mobile phone and bring it at the point of contact at the point of activation, where now it could be 25% of the value of that mobile device. But it didn't see the right during the Parliament, since Parliament dropped it. But what this was meant, the importers could be able to import higher unit of smartphones, since the cost could significantly go down during the importation. But they could import these devices at a very lower cost, but and get to the shelf at a lower cost. But when the activation is done, that's when the hike could be felt by the buyer, since the seller who will not bear the cost of the excise duty of 25%, could end up and transfer the cost to the buyer, and then the cost is transferred to the buyer during the purchase of the device. Since you get a device or an Android phone retailing for 10,000, or the Android phone which was retailing for 12,500 could now be retaining at 10,000, but you'll be required to pay an additional amount which will be taxed. So the shelf price could be lower, but when paying, you get yourself paying higher, since you'll be paying that cost of the phone additional to an excise duty of 25%, which you could end up also paying the phone at the value of 12,500 again. So it could be bringing a purchase shock to the buyers, since they could be expecting to pay lower price than they see in the shops, but end up paying higher taxes. Also, the government was trying to monitor every device which is sold in the country and monitoring the internet. So the government wanted to harmonize and be able to monitor the devices being sold in the market. So it was a technique to register all the devices which get into the market. Immediately the IMEI number or MI number of the phone is being captured by the government directly before the activation of the circular data of the internet. Since before you pay the activation fee using M-Pesa, the device will not have internet and you cannot be able to use that device. So it is strict monitoring of the device which you are using by the government, which I don't think there was proper public participation regarding this. But all in all, what this could lead is the ripple effect in the economy, where a lot of buyers could shift to the black market of the phone. And immediately there is a phone black market, these usually translate to higher debt when it comes to the phone. Even there have been high rate of crime when it comes to snatching on smartphone this year. So I don't think I am trying to think what this could translate to in case it went through the parliament, since the black market could start booming more vigorously, and your phone now will not be safe again in town. You have to shift and be leaving your phone at home, like simu ya jamii. So let us continue and get to the third controversial and the final controversial clause, which was being suggested by the Treasury. It didn't get its eye to the also to the final bill which was passed, and that was the controversial bill, which was allowing KRA to freeze the taxpayer accounts in case they have a legal battle with the taxpayer. What this was suggesting is that the National Treasury was making it easier for KRA to be able to freeze the taxpayer bank account. Therefore, this usually happen more consistently on the banks or people with high income margin. In case you have a legal dispute with the KRA and you get an agency notice, KRA wanted to make it easy to freeze your account and force you to pay the tax liability even before going to the tribunal. But as we know, in the previous tax regime, you are before you pay the tax liability which you are disputing KRA with, you can go to the tribunal where at the same time you can be able to be accessing your bank account very easily. And because what the freezing of bank account usually translate is it usually halt the cash flow of the business. And as we know, business is all about the cash flow. So freezing of the bank, it is paralyzing your business. So you are supposed to go to the tribunal, and when tribunal vote at the favor or make a decision in favor of KRA, you are supposed to pay the tax due. And in case it make against your favor, against the favor of the KRA, you add there and maybe KRA pay you the damage which they have caused to you. So that is technically what it resulted in the previous regime. But now KRA was requiring, even before you go into the tribunal, you first pay the contested tax liability which KRA is disposing to you, and then go to the tribunal. And if the tribunal votes otherwise, the KRA can do the refund. And if it doesn't vote otherwise, the KRA return the amount. But this could be disfavorable to a lot of businesses which usually have a lot of petition with KRA in the tribunals, and they keep on suing, and those cases can take even to 10 years. So the National Treasury had envisioned this, and it was trying to cut this line where business live in court with the KRA, and with decisions which are prolonged to be made, and KRA lose a lot of revenue. So this finance bill was more of compliance size and trying to cross a lot of loopholes which make the revenue authority lose a lot of revenue when it comes to the agency notice which is there, and they lose a lot of revenue on that area. So I was trying to make this simple as possible. So these are some of the controversial clauses which were the major one we didn't see the right into the final bill which was passed by the parliament. So in case you have any query or any additional information, you can put it in the comment section. Basically, thank you for watching and have a nice day ahead.